Hello, and I'd like to welcome my guest, Jean-Claude Trichet. Welcome, and I'd like to say a few things. First of all, Mr. Trichet, if my memory serves me correctly, you were the last ECB president to raise interest rates in 2011. Then, of course, Mario Draghi took over. But we see that there was a pivot. We see that Christine Lagarde went from, we're not up to the pace of the U.S., we're going to be looking more to remove stimulus in 23. But look what the markets have done this week, Mr. Trichet. We're up 15 basis points in U.S. 2-year. We're up 36 basis points in the 2-year shots in Europe. We're up 15 on those 10s, just referenced at 192. And Bund yields are up 1/4 of a point, up 25 basis points on the week. Energy prices are skyrocketing. And in Europe, where are they going to source new energy? Russia? So I ask you, Jean-Claude Trichet, always known as a hawk, is it too late for central banks? Are they going to have to go too fast? Can they avoid throwing these economies in a recession? What are your thoughts on yesterday's ECB pivot?
Rick, first of all, thank you very much for your invitation. Second, I am not sure that I am such a hawk because you might remember I was the first to purchase treasuries of Greece, Ireland, Portugal, Italy, and Spain. So I went very, very boldly on the non-conventional part of the monetary policy. But that being said, I would say clearly we are all, US, Europe, all advanced economies are at an inflection point. It's clear. The main danger before was the materialization of the deflationary risk. And now we are all in a situation where there is no more real deflationary risk. And of course, each central bank has to take the appropriate decision, taking into account its own situation. Situations are not the same on both sides of the Atlantic. I would say headline inflation is significantly higher in the US. I am looking much more at core inflation, and core inflation is something that like 2.5% in Europe, more than 5% in the US. So we are in a different universe from that standpoint. And I have to say the main danger in the present situation are the second round effects and the possibility that wages and salaries could increase much more than what would be desirable in the perspective of, I would say, price stability in the long term, and also in the perspective of the interest of employees and workers, because they have no interest in having a big, high inflation. So I would say in this respect also, Europe and the US are not exactly alike. We see signs of augmentation of wages and salaries. Yeah.
Mr. Trichet, let me interrupt you. We see that the balance sheet of our Fed keeps growing. It's almost, of course, up to $9 trillion. We see a large balance sheet at the ECB, and we see that interest rates are going up by the MPC and the Bank of England. My question to you is, are both central banks, the U.S. and the EU, are they correct in saying that they need to stop their buying programs before they start raising rates? What are your thoughts on balance sheet reduction, especially considering how much of that balance sheet is used up should we see a recession due to the rising of rates at some point in the future?
Well, they have obviously two measures that were combined in the past, are still combined, you're right. The purchase of tradable securities on the one hand and the rate of interest on the other hand are more or less associated in the present presentation of the forward guidance. I have to say I would insist much more personally on the fact that flexibility seems to me the rule of the game on both sides of the Atlantic. And this idea that the two central banks and the other central banks of the advanced economy have a goal, which is price stability. They agree on the definition of price stability, namely 2% in the medium and long run. And it seems to me that they gave themselves the flexibility to do what would be necessary to credibilize their own institution and, of course, the inflation expectations. Credibility at the present moment is the rule of the game